Let's continue with the macro-fiscal resilience pillars. So again, remember, we're trying to extend the disaster resilience strategy framework to adaptation. And this is one of the pillars, the macro-fiscal resilience pillar. This pillar focuses on tailoring financial strategies to ensure macro-fiscal resilience to residual risks and sustainable and timely financing adaptation policies. A comprehensive strategy would mainly consist of two objectives. One is ensuring adequate fiscal space and the mobilization of financial resources for adaptation policies under the prevention and alleviation pillars despite added costs from residual risks. Secondly, insurance against large risks and securing timely access to liquidity in the aftermath of climate disasters. So there is the general idea of disasters, Sendai framework. Now climate itself is a disaster in terms of potential impacts, region specific, but still could be landslides, storm surge, hurricane, droughts, floods, whatever. Reflecting climate costs in macro frameworks and public sector balance sheets is a prerequisite to the development of sound financial strategies. Right? Climate change will change fiscal sustainability in two ways. First, with respect to a baseline scenario without climate impacts, the unmitigated effects of climate change or residual risks will generate direct passive losses for the public sector through lower revenue, for example GDP losses that translate into a reduction of tax base, increased expenditure, for example increased interest rate risk premium as in these papers, or a greater use of automatic stabilizers. The accelerated depreciation of the accelerated depression or outright destruction of public assets and the realization of implicit liabilities, for example when governments bail out failing private agents. And these are in the first as to how climate change will challenge fiscal sustainability. The second of these is active adaptation policies under the prevention and alleviation pillars may generate public revenues that do not cover the totality of costs or that might only do so after a long period. So you are mainstreaming adaptation into fiscal policies, which means eventually allocating budget on adaptation for the future. And it's like you are hedging against a future risk. Till the risk happens, how do you estimate the benefit of that investment? So that may take a while. Either way, the investment from the prevention and alleviation pillars that generate some revenues, but they may not cover the totality of the costs involved in the investment to achieve these pillars in the climate disaster scenarios. Fiscal space and diversified revenue sources contribute greatly to resilience to climate change shocks. Fiscal space, so sustainable fiscal balances and debt levels, facilitates access to financing at lower cost for all public development policies, including adaptation policies. Additionally, it contributes to avoiding crowding out the financing available for private sector adaptation. Tax systems that rely on a few vulnerable sectors, as could be the case in a small agricultural country prone to droughts, is a source of financial vulnerability that warrants addressing either by diversifying the tax base or by engaging in financial insurance schemes. So if a small country is very tailored to a niche tax base like fisheries export, aquaculture, or there are various such small states which may be doing well as long as that one niche business is going well. But if you get hammered by climate change that affects your fisheries or your aquaculture or your agricultural productivity and so on, then you have to have plans of diversifying the tax base, okay? Or you need some insurance schemes. Note 1 we mentioned before argues that in most cases adaptation programs should only be implemented if they have a positive net present value for society. NPV is equal to the changes in consumer, producer, and government surplus, discounted and summed over the entire lifetime of the program. Discounting is basically how we reduce the value of a present rupee or dollar into the future. And this is a very tricky thing because there is no perfect way to define an appropriate discount. If you want to avoid investment, you can just use a high discount rate and say it's not worth investing because it'll value will be reduced very quickly. Or you can be more normatively choose a discount rate that's more reasonable. 3% versus 5% versus 10% can make a big difference in how the net present value is affected by discounted future. Okay, so keep those things in mind. The change in government surplus is equal to the revenues generated by the program minus the expenses. A positive NPV does not guarantee that the change in the government surplus is positive, or equivalently that the adaptation program is self-financing. Let me take care of something here for just a second. Okay, sorry about that. Continuing with the macro-fiscal pillar that macro-fiscal resilience pillar, let's continue the discussion. Fiscal space and diversified revenue sources contribute greatly to resilience to climate shocks. Right? This is obvious as well, which I think I already read. And note 1, we already looked at NPV. Moving forward, many adaptation programs won't be self-financing, and together with the fiscal costs of residual risks will require creating fiscal space, greater financing, or both. This comes up in the IPCC, UNFCCC, I don't know how many C's I said, discussions, agreements as well, because loss and damage as a tool to help countries which cannot manage their own adaptation and they are not responsible for most of what has happened thus far but are paying a price, like Pakistan getting flooded in 2022, 2010, or Philippines getting hit by a typhoon that will wipe out many of its tax-based activities. Loss and damage is supposed to provide help. So this is a very controversial topic because rich countries say, if we provide help, then are we legally responsible, saying we caused the damage in some ways, or we added to the damage from the flood, from the typhoon, because they got worse because of climate change, and we are responsible for climate change. So how this loss and damage will play out is not yet clear, but in the meantime, within the country level, many adaptation programs won't be self-financing. So together with fiscal costs of residual risk, they will require creating fiscal space, greater financing, or both in terms of fiscal policies for planning and mainstreaming adaptation into fiscal policies. Some adaptation policies can be self-financing over the long term, but may require temporary financing because benefits only accrue after upfront costs. I have my door open for a nice cross breeze. AC cannot be turned on because I want to live without AC as much as possible. But there is somebody walking around talking loudly on the phone. So let me read it again. Some adaptation policies can be self-financing over the long term, but may require temporary financing because benefits only accrue after upfront costs. Weather disasters can generate pressing financing and liquidity needs that require adapted insurance strategies, which is discussed in these several reports and papers. What do we mean? Climate disasters destroy capital and temporarily lower productivity, which means tax base, thereby generating potentially large reconstruction and humanitarian needs. There are typically large opportunity costs of delaying reconstruction and humanitarian aid. Opportunity cost is basically the cost you incur or the profit you lose by taking pathway A versus option B. So these are hard to estimate. There are typically large opportunity costs of delaying reconstruction and humanitarian aid. Therefore, it can be crucial to have insurance solutions for countries with otherwise constrained or limited access to international finance. Different instruments are best suited to address the shocks of different frequencies. Insurance itself is playing out in different ways because many insurance companies are now refusing coverage in many places because climate disasters have become more frequent and more demanding in terms of insurance payouts. So that may act as an external agent to force adaptation and mitigation. Mitigation is a global thing, but adaptation at least can be influenced by not getting underwriters for your risk, for the inefficient risk you may be taking, like building near the coastline or in the path of cyclones, sea level rise, and so on. Okay. To address small recurring shocks, self-insurance in the form of budgetary instrument is an inexpensive and flexible solution. For example, budget reallocations within the confines of the approved budget or supplementary budgets, provisions, or reserve funds. There are examples from Mexico and so on, which I will not read. For larger disasters, instruments that transfer risks to international markets, although expensive, might be beneficial. As I said before, this may not always be possible because Swiss Re, Munich Re, the reinsurers which support the international insurance markets, let's say, are doing their own computations of risks to their payouts to the insurance companies. So reinsurers insure the insurance companies. So insurance companies can get greedy and insure all kinds of projects that are not very risk informed or inefficient in risk taking. But reinsurers can then say this is not good and we will not support this kind of underwriting and so on. Insurance and state contingent debt instruments reduce default risks for investors and imply net financing for debtors when facing large shocks. These instruments include contingent credit lines from development partners, regional risk sharing facilities, for example, the Caribbean Catastrophic Risk Insurance Facility, the Pacific Catastrophic Risk Assessment and Financing Initiative, the African Risk Capacity, South Asian Disaster Risk Insurance Facility, and so on, and private insurance and catastrophe bonds. Okay, so let me read off one more item before we leave and come back to the figure. Governments can support adaptation by promoting efficient financial risk management in the private sector. Ensuring adequate private risk management would be beneficial for government's budgets by reducing government assistance needs. Financial regulations could be strengthened to that end. The same layering approach could prevail for private agents. Savings and provisions can be encouraged for frequent risks, whereas insurance products can be promoted against large but infrequent risks. So low probable, high impact risks can be underwritten by insurance products. Again, this is tricky because you are really dealing with future risks that are highly uncertain. So let's leave this and come back and look at a figure to make some additional points. Okay.